So basically, if your cash flows are nothing but your dividends and the future price, then it is going to be a discounted value of the future cash flows. I hope that I'm clear in terms of the audio. In case somebody has an issue, please put it in terms of, if somebody is not able to hear correctly, please put it right away. Okay. So basically, value of equity will be the next expected dividend plus the future price divided by 1 plus K naught, where K naught is nothing but the cost of equity. Now, one of the mistakes that people tend to make very commonly is that they generally take the last dividend and they do not take into consideration the next dividend. So if the question says that the last dividend was $1 and dividends grow at a rate of, let's say, 5%, and the future price of the stock is $30, then the valuation of equity, it has to make use of the dividend which is going to be D naught into 1 plus G, which is going to be $1.05 plus 30, which is the price of the stock, divided by 1 plus cost of equity. So in case if you are assuming the cost of equity to be 20%, then it will be 1 plus 20%. So this is a mistake which people tend to make, that if the question says that the last dividend paid was $1, then they tend to use the same amount while calculating the value of equity. Now, there is a critical relationship between the cost of equity and the dividend growth rate. Higher is the difference between these two, which means that there will be a higher value to the equity. As the gap narrows down, the value of equity will tend to fall. Now, one of the critical assumptions of infinite period dividend discount model is that the cost of equity is greater than the growth rate. We cannot have where the cost of equity is less than the dividend growth rate. If that is the case, then we may not be able to use this model for valuation. Now next, I want to move on to valuing equity by means of multiples. So before I move on to the different multiples, one must be very clear as to what is the importance or the significance of each of these multiples and when one should use which multiple. So prices to equity will be the most commonly used multiple, which is nothing but the price of the stock divided by earning per share. Now if I were to simplify this, if I were to look at this from a dividend discount model viewpoint, then this is going to be nothing but 1 minus retention ratio upon 1 plus the cost of equity. So which I can again say that this is nothing but 1 minus retention ratio divided by 1 plus KE. So this is the prices to equity multiple. Now if one was to look at what is the growth rate, so if one wants to compute what is the growth rate, then the growth rate is nothing but the retention ratio into the return on equity. So there are questions which can test you for calculating the prices to earnings ratio, or there could be a question which could test you to calculate the growth rate. Now prices to earning multiple is a good way of comparing different stocks. However, this multiple measure will fail if the earning per share is negative. Now this is the case with most of the companies who are in the initiation phase or who are in the startup phase, because in such a case companies will not have a positive earnings. So in such a case, a better measure would be to use the prices to book value multiple. So the prices to book value multiple is nothing but the price of the stock divided by book value of the stock. So basically book value is nothing but the cumulative value of all the earnings which one can see it on the balance sheet. So the book value would be nothing but equal to the net worth, or book value per share would be nothing but equal to net worth per share. So prices to book value is a multiple which one can use to evaluate companies where earnings per share is negative, or in case if the earnings per share is highly volatile, that is, if the company has highly volatile earnings, then one may be better off using this multiple. Now, the book value of the firm will be much more stable compared to the earning multiple, so one uses this. Next, one could use the prices to sales multiple, and similarly, one may make use of the prices to cash flow multiple. So this is nothing but the earnings multiplier model, where I'm trying to say is that if I've got infinite dividends, then prices to earnings will be nothing but 1 minus retention ratio upon K minus G, and G can be further written as retention ratio into ROE. Now, in this case, one must be very careful as to whether one is referring to the trailing multiple or the leading multiple. So in this case, since we are using the next quarter earnings or the next year earnings, this is called a forward or a leading multiple. If one was to use the actual earnings, then this would become a trailing multiple. Now, next we'll try to see what are the different ways of forming an index. So an index can be constituted by 3 different ways. So the first way would be based on the price weighting, the second way would be on market cap weighting, and the third would be on equal weighted. So basically, if I were to refer to the National Stock Exchange or the NSE, Nifty, or the BSE Sensex, they are both market cap weighted index, whereas you could also have price weighted indexes and indexes which would be equally weighted. So next we'll move on to the equally weighted index, where all the stocks are weighted equally irrespective of whatever their price is or whatever their market cap is. So this is not a good way of forming an index, because in this case the better performing stocks will not be given that weight which they deserve. And the third way is the price weighted method. Now next I want to come to is how one can estimate the EPS. Now there could be questions which could test you on the concentration ratio and the HHI or the Herfindahl index. So one must be very careful as to what is the HHI index. So HHI index is nothing but the summation of the market share of each firm, square of that. So one must not forget to square each market shares, and this has to be summed for all the different firms. Now the most important thing which I want to stress upon is the difference between the free cash flow to firm, the free cash flow to equity, and the enterprise value. So basically, what is free cash flow to firm? This is nothing but the cash flow from operations. Free cash flow to equity would be nothing but cash flow from operations minus the fixed investments, which will be nothing but an outflow, plus the net borrowings. So basically, this is nothing but the cash flow which is available to all the equity holders. So if I were to value a firm effectively for each of the periods, I am going to look at the free cash flow to equity. So if I am going to value equity, it will be nothing but summation of FCFE divided by the cost of equity. So when I value equity in the numerator equity, if I am going to calculate the value of firm, then it will be nothing but summation of FCFF upon 1 upon cost of capital raised to that time period. So one must be very careful as to when one is discounting the free cash flow to equity, he has to discount using the cost of equity, and when one is using the free cash flow to firm, he has to make use of the weighted average cost of capital. Now the third measure which one uses very frequently is the enterprise value. So basically, enterprise value is nothing but the market cap of equity, that is nothing but the market value of equity, plus the market value of debt, minus the cash and cash equivalents. So typically one forgets to subtract this cash and cash equivalents. If one does not do it, then that will give an overestimation on the enterprise value. So with this, moreover, we are coming to an end to the session of equity. Now there are some more points which I would want to just stress upon when one is looking at equity valuation. So basically, before we move on, there are things like what is the difference between the book value and what does the market value represent. So book value is nothing but it reflects the historical operating and financing decisions of the management. So it's based on a historical measure, whereas the market value represents not only the historical measures but also the future cash flows which the company is likely to receive. So a market value is more of a factor which also takes into consideration the futuristic cash flows which the company is likely to receive. Now, whenever we are going for any security transaction, one always comes across terms like margin requirement. So whenever one is purchasing equity, he will go for a leverage if he is taking part in the futures and options segment. So leverage factor will be nothing but 1 upon the margin requirement, and the leverage returned or the levered return will be nothing but the holding period return into the leverage factor. So basically, because of this leverage factor, the levered return tends to increase multifolds, which one may not be able to recognize using the complete cash based delivery model. So this is the reason that people tend to go for futures and options rather than going for purely cash based buying. Now, one more thing which I would want to cover before we move on to fixed income is that markets or the portfolios can be constructed in two ways. So one is based on the active management theory, whereas the second is based on the passive management theory. However, markets need to be or the portfolios need to be rebalanced, or they need to be reconstituted at every point of time. So basically, rebalancing is nothing but when you are just changing the constitution or the composition of the percentage of instruments in the portfolio. So if I've got 4 different instruments, 1, 2 and 3, 4. So if I'm just changing the proportions of each of these instruments, then this is called rebalancing, whereas reconstitution will be nothing but replacing 1 or 2 of these components by some new components. So instead of 1, 2, 3, 4, the reconstitution may result in 3, 4, 5, 6. Basically, I have removed 2 stocks and added 2 other stocks, which means that I have reconstituted the portfolio. Now, one more point where questions come in are when one is going for a margin based purchase, what will be the margin call at which there will be a trigger? So in case of margin based purchase, the margin call trigger will be at the initial price into 1 minus the initial margin percentage divided by 1 minus the maintenance margin percentage. So basically there are 3 kinds of margin. Initial margin is nothing but the margin which one has to post right at the beginning. Then as the margin goes down, at one point of time, the broker may ask you to refill the margin. So that point would be nothing but the maintenance margin. So at the maintenance margin level, you will get a broker call to refill the margin back to the initial margin levels. So this difference between the initial margin and the maintenance margin would be the variation margin. So for a margin call based purchase, this is the margin call or the amount at which there will be a margin call. So at this value of the stock, one will get a margin call. Similarly, for a margin based selling or a short sell, there will be a margin call at a price which will be nothing but equal to P naught. That is, this is the margin call price into 1 plus initial margin percentage divided by 1 plus maintenance margin percentage. So typically students tend to make mistakes in terms of using the same negative sign even for a short sell. So that is not going to be the case. Finally, one must be very clear as to the different type of orders, because there is a lot of confusion which comes in. What is the difference between a market order, a limit order, a stop loss order? Then similarly, what is a discretionary order, time of the day order, open order, and a fill or kill order? So basically, there have been definitions which have been provided for each of this type of orders, and one must have a clarity as to what does each of the orders mean, because there could be theoretical questions which would be testing you on this. And finally, I would move on to the difference between the different forms of the efficient market hypothesis. So as per the efficient market hypothesis, markets could be either weak form efficient, a semi-strong form efficient, or a strong form efficient. So basically, markets would be weak form efficient if one is not able to generate any excess returns by making use of technical analysis. So technical analysis will not give you excess returns in case of a weak form efficient market hypothesis. Similarly, in case of a semi-strong form, one will not be able to generate any excess returns by means of fundamental analysis as well. So basically, in a semi-strong form market, both technical and fundamental will not give you any extra returns, and basically the prices of the stocks adjust automatically to any public information which arrives, which means that he is not going to generate any excess returns by any fundamental analysis. And in the strong form, investors will not be able to generate excess returns by making use of both public or private information, since the market knows each of this information right away. So this means that by means of insider trading as well, I will not be able to make excess returns. So with this, we now move on to fixed income. So basically, in case of fixed income, there are different features of a bond. So you could have a bond which would be a floating bond, or a fixed rate bond, or a zero coupon bond. Similarly, bonds can be classified further based on their seniority. So they could be senior secured debt, then you could have the senior unsecured debt, then you would have a subordinated debt, then you would have a junior subordinated debt. Further, when we are referring to bond theory, one must be clear about terms like what is a sinking fund, what is a call provision, and what is an amortizing security, because these are the terms which are frequently used. So in case of sinking fund means nothing but the interest which must be kept aside in a fund if it is not being paid upfront to the bondholders. So in case of zero coupon bond, there is no coupon payment in between. So the securities are issued at a discount, and at the maturity one gets the par value. So the accrued interest will have to be deposited in the sinking fund, and when one is redeeming the bonds at maturity, he will be paid this sinking fund value, which is nothing but the accrued coupons. Now next, one must focus upon the different kinds of risk which bonds are subject to. So the biggest risk is nothing but the interest rate risk, then you have got the reinvestment risk, then you have got credit risk, sovereign risk, event risk, and you would have some other form of risk like a liquidity risk. So basically, interest rate risk is nothing but how does a change in interest rates affect my bond value. So basically, we make use of measures like duration to capture the interest rate risk. The next way of capturing interest rate risk would be convexity. So duration is nothing but a approximation, so one makes use of an additional term which is convexity. Now reinvestment risk is nothing but the risk that the bondholders will return the money if they get some better opportunities in the market. So a borrower would be returning the money if he is able to generate debt in the market at a lower cost. So if a borrower has borrowed money from bondholders at 7%, and if it happens that now the interest rates in the market is 5%, then typically the borrower will want to return the money to the bondholders so that he can generate, or he can take money from the markets at a lower rate. So this is a reinvestment risk. Next is the credit risk. So credit risk is basically nothing but the risk that the borrower will default and not pay the interest payments or the principal payments on time, because of which there is a loss to the bondholders. Finally, then we have got sovereign risk, which is nothing but the risk that the rating of the sovereign may come down, or the sovereign may default, which means that all the companies which are part of that sovereign may also indirectly default. And one more risk is nothing but the liquidity risk, which is nothing but the risk of not being able to liquidate the bonds or sell the bonds in the secondary market. So generally bonds are issued in the primary market. That is nothing but where the borrower directly takes the debt and issues bonds to the primary investor. Then this investor would want to trade the bonds in the secondary market. So there is likeliness that the bonds may not be traded frequently, which means that there's not much of liquidity, which results in liquidity risk. So now let me come down to the basic bond pricing formula. So the basic bond pricing formula is nothing but similar to something which we looked at in equity as well. So in equity we have looked at that value of equity is nothing but discounted cash flow of all the free cash flow to firm for the respective years. So if I have to just see the relation between these two, so this was nothing but I was discounting the free cash flow to the firm for each of the years at the respective cost of equity. Similarly, in case of the bond, I am discounting the cash flows with the respective discounting rates. So in this case, the discounting rate is nothing but called the yield to maturity. So yield to maturity is nothing but a single rate of discounting which makes the discounted value of the bond equal to the market price of the bond. Now the yield to maturity will be nothing but the GSEC yield plus a spread. So this spread will be nothing but a function of the credit rating of the bond, which will nothing but capture the credit risk, and at the same time it will be a factor of the liquidity of the bond, which will capture the liquidity risk. So this spread, which is nothing but the difference between the yield to maturity and the GSEC yield, is called the nominal spread. However, there are two other forms of calculating the spread. So the second would be the Z spread. So Z spread is nothing but the additional spread above the spot rate. So it's not the difference between the treasury yield and the YTM. It's the difference between the treasury yield, or the, I would say, the YTM and the 1 year spot rate. So this would be the Z spread, which is nothing but the difference between the YTM and the 1 year spot rate. Then similarly I would have a Z spread, which is nothing but the difference between the 2 year spot rate and the YTM. However, this Z spread is going to be a common number, which when added to each of the spot rates gives me the YTM. So this cannot be a separate number for each of the coupons. It has to be the same number. And finally, we have callable or puttable bonds. So basically in such cases I will have an option adjusted spread. So the option adjusted spread will be nothing but the difference between the Z spread and the option cost. Now in case of callable bonds, the option cost is positive. Why? Because callable option is nothing but option purchased by the borrower to call back the bonds before maturity. Whereas in case of puttable bonds, this option cost will be negative. So this is going to give me the option adjusted spread. Now one must have a very good understanding of the difference between the bond equivalent yield and the annual equivalent yield. So whatever is quoted typically is nothing but the bond equivalent yield, and one can calculate the bond equivalent yield from the annual equivalent yield using this formula. On the other hand, one can translate the bond equivalent yield into the annual equivalent yield using the second formula. So basically this is nothing but the readjustment of this formula to arrive at the annual equivalent yield. Now we had seen at what is the interest rate risk. So interest rate risk is nothing but how the value of the bond varies with the yield. So basically first I need to know what is the yield curve. So this is nothing but the price of the bond for different values of the yield. So as yield comes down, the value of the bond goes on increasing. So price and yield have an inverse relationship. Now one must be very aware, very clear as to that for higher values of yield, a small change in the yield will not result in a large change in the price. So small change in yield will result in small delta P or change in price. However, for lower values of yield, at this point, even a small change in the yield will result in a large change in the price. So basically, the sensitivity of price at large values of yield will be different compared to the sensitivity of price to small values of yield. Now, sensitivity of price to yield is measured by means of duration and convexity. So basically, duration is nothing but change in value of the bond for change in value of the yield by delta Y, and it is measured using this formula. So if I am looking at the value of the bond V0, if the yield were to move to delta Y, so if the yield were to become Y plus delta Y, let me say that the price of the bond will change to V1. So V1 will be obviously be less than V0. Similarly, if the yield were to fall to Y minus delta Y, then if the value of the bond is V2, now V2 will be greater than V0. So if I were to measure the duration, then duration will be nothing but V1 minus or V2 minus V1 divided by 2 times V0 into delta Y. Now one must have a clarity as to this duration is nothing but the Macaulay duration or the effective duration. Now modified duration is typically used, which is nothing but Macaulay duration divided by the 1 plus YTM. So this is something which one must remember. Now in addition to duration, one also tends to bring in convexity, because duration is an approximation based method. So duration based approximation is only valid if delta Y is very small. It does not hold true if delta Y is large. So in such a case, I have got an additional term which is nothing but the convexity. So percentage change in price of this bond will be nothing but minus duration into delta Y, because duration as a number will be a positive number. However, duration is nothing but reflecting the change in price for some change in yield, which means it has to be a negative number. So this is the negative sign into delta Y plus convexity into delta Y square into 100. Now some of the texts make use of percentage delta P is nothing but minus duration into delta Y plus half into convexity into delta Y square. So both, there are two ways of stating this formula. So in this formula, I have already divided the convexity by half beforehand. However, if there was an exam question which was to come in, then one must make use of this formula where there will be a half term which will come in. Now once we have looked at the yield curve, so this is nothing but the yield curve. Similar to yield curve, I have got a term structure of yield. So term structure of yield is nothing but how the yield moves compared to the different tenors. So I could have a upward sloping curve, I could have a downward sloping curve, or I could have something like a humped curve. So term structure, there are certain term structure theories which are nothing but the liquidity preference theory, the market segmentation theory, and the pure expectations theory. So these are three theories which explain as to how the term structure or how the yield will vary over the tenors. So basically I have looked, or I have discussed earlier as to bonds can also be classified on the basis of the seniority. So this is the most senior bond, whereas this is the most junior bond. So this means that bondholders are very safe here. Why? Because they have the first right if the company goes bankrupt, whereas in this case the bondholders may have to bear the loss. So basically this is nothing but like an equity holder. So effectively, as one moves down, the equity nature or the loss bearing nature increases, and as the loss bearing nature increases, these bondholders will ask for a higher coupon compared to the senior bondholders. So senior bondholders will have a lower coupon. At the same time, the senior bondholders will be very highly rated, so AAA or a AA plus would be a typical rating of such bonds, whereas junior bonds would have a lower rating. So typically their rating would be somewhere around A minus, or let's say triple B, in case they are investment grade bonds. Now basically any bond which is above a rating of triple B minus is a investment grade bond, whereas bonds below double B are non-investment grade bonds. So the current yield of a bond does not change with the frequency of coupon payments. So the current or the yield to maturity of the bond is going to remain the same whether coupons are paid annually, semi-annually, quarterly, or it could be on a daily basis. Now duration of the bond is going to be dependent upon three things. Higher the tenor of the bond, higher is the duration. So duration is directly proportional to the maturity of the bond. Similarly, duration increases as coupon rate decreases. Why? Because if the coupons are going to be lower, that means that most of the cash flow is going to come at a later point of time, which means the duration will be high. And third, duration increases as yield to maturity again decreases. So duration is affected by three different factors: the maturity, yield to maturity, and the coupon rate. Next, I would want to discuss how one can derive forward rates using the spot rates. So this process is called or referred to as bootstrapping, and there have been a lot of questions which test you on bootstrapping. So basically I would just want to take some space as to, if I'm looking at a 2-year bond, I would have a 1-year spot rate. So this is nothing but the rate which I would get on a 1-year FD. Similarly, I would have something like a 2-year spot rate, which is nothing but the rate on a 2-year FD. Now if one wants to derive the forward rate between t equal to 1 and 2, effectively for there to be no arbitrage, 1 plus the spot rate for 2 years, or the return on a cash flow of 100 rupees after 2 years based on the 2-year FD rate, should be the same as this 1 plus the 1-year spot rate into 1 plus the forward rate. So this is going to be true. If this does not hold true, then there is going to be arbitrage. So this is for no arbitrage. So basically using this relationship, one can calculate the forward rates based on the spot rates. Now effectively the spot rates to forward rate computation is referred to as bootstrapping. Now the duration, one has to remember upfront that duration is nothing but a tenor of function of the tenor as well as the coupon payments. So duration is going to be highest for coupon paying bonds, or sorry, zero coupon bonds, that is no coupon paying bonds. And if I were to compare a callable bond versus a non-callable bond, so this is something which is tested, then the duration of a callable bond will be less compared to the duration of a non-callable bond. So basically, before we conclude, I would want to discuss the difference between a callable bond, a puttable bond, and a simple bond. So a simple bond is something where the borrower or the bondholder cannot either call back the money or return the money. In case of callable bond, if the yield falls very low, that is if the yield decreases significantly, then the borrower can return the money or he can call back the bond. So if this is for a non-callable bond, this is nothing but the yield curve. If this is the call price at which he is planning to call back the bond, so initially the yield was somewhere here. Now yield started falling, which means the price went on going up. Now if it was a non-callable bond, then that would mean that the price would go further up and the borrower cannot return the money or call back the bond. If he has got a clause which says that he can call back the bond at a specified price or once the yield goes below a certain price, that means that he is going to call back the bond and he is going to pay the bondholders a value equivalent to P call. In case of a puttable bond, if the interest rates were to increase significantly, which means that bondholders would expect a higher interest rate than what they are receiving, in such a case the bondholders may return the money back, or they return the bond back and take back the money. So in such a case, if initially the interest rate was somewhere here, if the interest rates go on increasing, which means the price of the bond is going down, then at this price they may decide to take their money back and return the bond. So this is called the put price. Now since call, this is nothing but an option which is lying with the borrower, that means that price of such a bond, or I would say that the coupon rate on such a bond will be greater than that for a non-callable bond. Why? Because it's a option which is available with the borrower, which means that the bond holders will ask for a higher coupon rate. In the other case, that is in the case of a puttable bond, the option is with bond holders, that is they can return the bond back and take back their money once it falls below a certain value. This means that this is more of an incentive to the bond holders. So the coupon rate on this bond will be less than the case of a non-callable bond. Why? Because the borrower will not be willing to pay a higher coupon rate since he is already giving the bond holders an option. So with this, we have calculated, or we have covered most of the concepts which one has to remember in the equity and fixed income, and there are certain things which we have discussed which must be kept in mind when one is revising the syllabus. Now I would want to take up some questions so that we can take up most of the doubts. Convexity must be divided by 2. So this is more of an approximation, or this is more of a calculation which is derived using the Taylor series. So I would not want to get into Taylor series. From the exam viewpoint, I would suggest that one has to remember clearly that one has to divide convexity by 2. The next question, why security calculation done by 32% of par? Okay, I'm not able to get what is this question trying to say. Can you post it once again as to what is this question trying to say or convey?
Okay, in the meanwhile, I think we can go on to the next question.
Yeah, I'll take this one. So in what form of market would technical analysis be effective? So ideally, it would not be effective in any of the markets. So as per the efficient market hypothesis, even in weak form efficiency, technical analysis would not be effective. However, this is only under the assumptions of the efficient market hypothesis. In reality, you find deviations from the efficient market hypothesis. So if one were to think in reality or in practical world as to whether technical analysis gives you excess returns, my answer would be no. Whether, because most of the markets are at least weak form effective. Now if the markets are semi-strong form effective, which is the case with most of the developed markets, then even fundamental analysis will not give you an excess return. However, in emerging markets like India, which are not semi-strong form effective, you may get excess returns. Whereas in strong form efficiency, that is where there is no excess return even by insider trading, I think such markets would be the US markets or the European markets, where there is a large control exercised by the Securities Exchange Commission or the SEC. In India, one may be able to generate excess returns by means of insider trading, and there have been multiple cases in the past. So in fact, if you were to ask me, Indian markets are not strong form efficient, or even they are not semi-strong form efficient, whereas developed markets, especially if you were to refer to the Nasdaq, they are strong form efficient. That is, one is not able to generate excess returns by means of even technical, fundamental or private information, that is insider trading. So next I would want to take what is the Z spread. So typically, as I discussed, Z spread is nothing but a single spread which, if it is added to the spot rate curve, so effectively I would be having a spot rate curve or a spot rate term structure. So this is going to be the term structure of my spot rate. So I will have the tenors here and I will have the spot rates here. Let's say my spot rate curve is, let's say, an upward moving curve, which means that this is nothing but the 1 year spot rate, this is the 2 year spot rate, and so on. Now Z spread is nothing but a common spread which one must add to each of the spot rates so that it becomes equal to the yield to maturity. So this spread which is added to each of the spot rates is the Z spread. The difference between Z spread and the nominal spread is that the nominal spread is nothing but the spread which is added to the GSEC yield to arrive the yield to maturity. So the difference is the underlying. In case of nominal spread, you add the spread to the GSEC yield. In case of Z spread, it is added to the spot rates. Now next question I would want to, so the question says that Schwezer material says that we are not supposed to calculate Z spread. Yeah, one may not ask you directly in exam to calculate the Z spread. However, one must be theoretically aware as to what does this spread mean, and if one has to interpret as to which is a bond with a higher Z spread, then one must try to compare the YTMs with the spot rates and interpret which is the bond with a higher Z spread. So there would be theoretical questions on Z spread and they would not be asking you directly to calculate the Z spread in the exam. Again, I think this is the same question. Are we required to compute or calculate the Z spread? Not really. However, one must clearly remember the theoretical meaning of the Z spread. In case one was to ask you to compute the Z spread in the exam, then one may not be able to directly calculate the Z spread. So one can assume different values of Z spread or values of, and check where the price equals discounted value. However, this is not typically forming a part of the syllabus, at least for CFA level 1. Okay, bonds are sometimes quoted as 988 and 1/2. So typically when a bond is said that the value of the bond is 988 and 1/32, that means the value of the bond is 988 plus 1/32. So this is a way of notifying or stating the value of the bond. So this is nothing but the integral value of the bond, whereas this is nothing but giving you the decimal value of the bond. So when one has to convert this, it will be 988 plus 1/32. So this is the way bonds are quoted. Now, are Macaulay and effective duration the same thing? So effective duration is one way of computing the value of duration when I'm looking at a change in yield, that is delta y, on the upper side as well as on the lower side. How does the value of my bond change? Now, Macaulay duration is nothing but duration in terms of years. So duration can be stated in terms of how much will the value of my bond change for a particular value of the yield. That is nothing but the dollar duration. Whereas the other way of stating the duration is nothing but in how many years will I get back the entire invested cash flow. So that would be in terms of years. So if one was to ask me whether Macaulay and effective duration are the same thing, they are not the same thing because they are measured in different units. So the next question I would want to take up is, what is the equity multiplier? So can you just come back to the slides? I'll just 1 minute go back to the. So whenever I'm doing purchase of stocks based on margins, so basically I'm saying that I'm going to purchase a 100 rupee stock. However, I'm just going to keep 25 rupees as a margin, which means that I'm multiplying an amount, or I'm purchasing an amount which is 4 times the value of the margin I have put in. So basically I'm putting 25 rupees as equity, whereas the rest 75 is nothing but a debt. So this is nothing but a margin multiplier or an equity multiplier, or somebody might say it's a leverage multiplier, by means of which one is able to maximize the profits by putting in less amount of money. So this is nothing but the same as the margin multiplier. So I think with this I have covered most of the questions. Okay, can someone, this question was, so basically if one was to ask you to calculate the change in the price of the bond, okay, if the change in the price of the bond is 50 pips, then I have to always make use of 0.5%. If duration is given in a number, so that depends on whether I have to use 0.5% or 50 by 10,000. That depends on how is the duration given. Now if duration is given as DV01, then market value of the bond into, I will make use of the term which is nothing but 50 divided by 10,000. So if duration is given as DV01, then the change in value will be nothing but DV01 into whatever change that is happening, that is 50, into the market value of the bond. So based on how the duration has been stated, I can calculate the change in value of the bond. And on the other hand, if I want to calculate DV01, then that will be nothing but equal to duration into market value of the bond divided by 10,000. So depending upon what I want, I can calculate the duration or the DV01 using the above mentioned formula. So DV01 is nothing but the same as the PVBP calculation. That is, they are the same things, but they are just stated in different ways. Now next what I want to touch upon is, I think we have covered most of the questions. Anything which is remaining? Okay, I am not able to interpret one question which is posted. It's related to mutual fund. So what is related to mutual fund?
No, that was actually asked whether the webinar is related to mutual funds or equity.
Okay, fair. So I think this is okay. Can it be calculated with the help of Texas? So this is, I think, to compute the Z spread. Yeah, it cannot be directly computed using Texas BA2 plus. So one can just make use of some arbitrary values of the Z spread and see if the market price of the bond turns out equal to the discounted value of the cash flows. So let's say you have been provided the spot rates for each of the years. So let's assume that you assume initially the Z spread to be 10 pips or 0.1%. Calculate the discounted value of the bond. If it equates the market price, then that is a Z spread. If it does not equate, then you can make a new approximation. Then you may go for Z equal to 15 pips, or you may go for, let's say, Z equal to 20 pips. So at one point there will be a crossover which will be happening. That means that at one value of the Z spread, your discounted value of the bond may be less than the market price of the bond, whereas at the second value of the Z spread, it may happen that the discounted value of the bond turns out to be greater than the market price of the bond. So this is a crossover, which means that the actual Z spread lies somewhere between these two values. After this, you can interpolate to calculate the approximate Z spread. However, this will not be a part of the exam calculations, so I don't think you all need to worry about it.
Okay, there's a question coming in which says the difference in coupon rate between callable and non-callable bonds. So would you like to repeat that once again, because it wasn't very clear to Jugal?
Yeah, so basically in case of callable bonds, one has to remember that interest rate risk is lower compared to the interest rate risk in case of a non-callable bond. Now what happens in case of callable bond? That if the yield is going to fall below a certain value, then the corporate or the borrower has the option to call back the bond. So let's say if I'm standing somewhere here when the bond was issued, if the yield started falling, which means the price of the bond started increasing, at some point the borrower has the right to call back the bond. This will be nothing but the call price. Now in case of such a bond, the interest rate risk is less compared to a non-callable bond. Why? Because I'm able to call back the bond at this call price, whereas if this option was not available to me, then the risk would have been higher, because then the price would have increased further for a change in the yield. So basically, if the interest rate risk is lower in case of a callable bond, that means that duration will be lower for a callable bond compared to a non-callable bond. If yield increases, the price decreases. So if interest rate increases, investor loses always? Yeah, that is the case. Why? Because you might have purchased when the yield was 7%. That time the value of the bond was 100 rupees. Today, if the yield has become 9%, which means that value of the bond will become 90 rupees. That means that if you were to go to the market to sell the bond, then you are going to lose out 10. Let me come back to the bootstrapping concept. So basically, what is the meaning of the word bootstrapping? That means bootstrapping is nothing but referring to a concept where one is calculating the forward rates from the spot rates, or it is nothing but a concept which links the forward rates and the spot rates, and the linking is done by the relation which I showed. So basically, this is the relation between the spot rates and the forward rates, and this is nothing but also called as the method of bootstrapping. So if I were to be given the 1 year spot rate and the 2 year spot rate, based on this spot rates, I can calculate the forward rate. Now why would I have the spot rates readily available? Basically, spot rates are nothing but like my FD rates. So 1 year spot rate is nothing but my 1 year FD rate. 2 year spot rate is nothing but my 2 year FD rate. Now if I want to calculate a forward rate from this, I need to make use of this equation, which is referred to as bootstrapping. Okay, if the security quoted calculation, in the treasury security quoted calculation, why we need to divide it by 32? So if the price of the bond is mentioned as, let's say, 950 and 6 by 32, that means it is nothing but $950 plus 6 by 32, and that is nothing but a way of convention which is used in the bond markets. So let's not get into why it is 32 and why it is not 35. That is the way that convention lies in the markets. So would the spot rates be specified for 6 months or 1 year? This is some other question. The spot rates will be specified, and based on the spot rates, you might be asked to calculate either probably the forward rate, or it can be the other way around. One could give you the forward rate. So one could give you the 1 year forward rate, and one would give you the 1 year spot rate, and one may ask you to calculate the 2 year spot rate. So it's like deriving the 2 year spot rate from the 1 year spot rate and the forward rate. So one again must make use of this equation. Okay, there is another way of calculating the forward rate. So this is nothing but another formula of calculating the forward rate, which is used many times. So this is nothing but the forward rate between 1 and 2. So this is nothing but the 2 year spot rate, this is nothing but the 1 year spot rate, and T1 and T2 are the respective tenors.
Okay, there's another question. It says, if yield increases, the price decrease. So if interest rate increase, investor loses anyways.
I think we have discussed this. I just discussed it a couple of questions back, that if the yield is going to be 7%, then the price of the bond is, let's say today, $100. Now if I were to see just the yield curve, that is the relation between price and the yield. So if the yield increases from 7% to 9%, that means the value of the bond may fall from 100 to 90. That means if one wanted to sell this bond today in the market, he is going to just get $90. The reason for this is that as yield increases, the discounting rate increases, which means when you are calculating the price of the bond, your denominator, which is nothing but the discounting rate, is increasing, which means the price of the bond is going to be lower. That means the investor loses.
Okay, I think that does bring us to the end of the session. Thank you, Vignesh, for this very informative session. In case you still have doubt, you can post it on our forum. That's on EduPristine.com. You can log on there. You have an option of the forum. And we have our in-house experts who dedicate themselves to solving your doubts. Do stay tuned for the next session. That would be tomorrow around the same time. And the topic would be quants. So we would be discussing all about quants tomorrow. Okay, thank you. Thank you, everyone. Thank you for attending. It was a great webinar.
Yeah.